Hey everyone, and welcome to today's explainer. If you've ever felt totally overwhelmed by the sheer noise of the financial markets, the daily price gyrations, the talking heads pontificating on TV, the endless, exhausting chase for the next hot trend, then this explainer is exactly what you need. We're going to completely cut through all of that noise today. Instead, we're looking at a deeply grounded, structural approach to investing that some of the absolute greatest minds in finance have used to build massive wealth over time.
Think about it. There are a lot of ways to make money in the stock market. You can play that exhausting Wall Street game, right? You can keep a sharp eye on trends. You can try to guess which companies are going to beat earnings estimates by a penny this quarter, or buy dirt cheap stocks hoping for a quick bounce. But, well, there is a simpler alternative. You can simply buy wonderful companies at reasonable prices and let those companies compound cash over long periods of time. It sounds incredibly simple, elegant even. But surprisingly, very few money managers actually follow this strategy, even though it is the exact playbook used by legendary investors like Warren Buffett.
And honestly, that elegant little philosophy is the entire foundation of the source material we are exploring today, The Little Book That Builds Wealth by Pat Dorsey. See, Pat was the director of stock research for Morningstar, which is a massive, independent investment research provider. And what this book does is distill Morningstar's immense stock research operation, an operation built by founder Joe Monsudo, by the way, into a highly focused, long-term wealth strategy. It gives us a fascinating inside look at the exact thought process they use to evaluate companies, establishing a totally logical foundation for building durable wealth.
All right. Let's jump right into Section 1, the ultimate investing game plan.
So, Pat Dorsey lays out this 4-step game plan, and it's actually incredibly straightforward. Step 1, identify businesses that can generate above-average profits for many years. Step 2, wait until the shares of those businesses trade for less than their intrinsic value, and then buy them. Step 3, hold those shares until the business deteriorates, the shares become overvalued, or maybe you just find a better investment. And crucially here, this holding period should be measured in years, not months. Finally, Step 4, repeat. Today, we are focusing really heavily on mastering that critical first step, finding those wonderful, above-average businesses with long-term potential. Because honestly, if you can do that, you're already ahead of most investors out there.
Now, you might be wondering, what exactly makes a business above average? I want you to step back for a second and think about the fundamental purpose of a company. A company is essentially just a giant machine. It takes in investor capital, it invests it in products or services, and it generates a return. A good business is a machine that creates more capital than it takes in. A bad business, on the other hand, spits out less capital than it took in. Simple, right? A company that can generate high returns on its capital for many years is going to compound your wealth at a prodigious clip. But here is where we run into a massive roadblock, because finding a good machine isn't actually enough to guarantee long-term wealth. And that brings us to Section 2, the problem with capitalism.
Here is the core conflict of investing, guys. High returns on capital attract competitors like bees to honey. That is literally just how capitalism works. Money naturally and aggressively seeks out the areas of highest expected returns. The very minute a company starts cranking out fat profits, boom, competition immediately arrives at its doorstep to take a piece of the action.
This relentless competition leads to a really critical economic concept called mean reverting returns. Basically, in the financial world, because of this relentless competition, returns on capital generally revert to the mean over time. Highly profitable companies see their returns dwindle as competitors aggressively move in on their turf. Conversely, companies with low returns might actually see them improve as competitors give up and leave the playing field. The harsh economic reality is that success naturally breeds the very competition that destroys it. So if capitalism is designed to destroy high profits, how do some companies like, say, Johnson & Johnson or Oracle manage to crank out high returns for decades?
How do they do it? Let's dive into Section 3. What is an economic moat?
Whenever you're planning to put your hard-earned money into a company, you need to stop and ask yourself one specific question. What prevents a smart, well-financed competitor from moving in on this company's turf? Don't just ask if the company is great today. Ask, what is stopping someone else from stealing their profits tomorrow? You really have to force yourself to look for structural defenses.
And that structural defense actually has a name. It's called an economic moat. An economic moat is a sustainable competitive advantage that protects a company against competitors, exactly the way a physical moat protects a medieval castle. This brilliant little term was actually originally coined by Warren Buffett to describe these structural wealth compounding shields.
It is literally the only thing that prevents those brutal forces of mean reverting returns from eroding a great company's profits. Now, while Warren Buffett is the guy who developed the concept, Morningstar took this kind of abstract, almost artistic idea and transformed it into a rigorous science. Joe Mansueto actually built Morningstar itself with the goal of having a wide economic moat, using things like trusted brands, massive databases, and proprietary analytics, but more importantly, they made this moat concept the absolute bedrock of their entire stock analysis foundation.
And Morningstar's methodology operates on a truly massive scale. We're talking over 100 stock analysts covering 2,000 publicly traded companies across 100 different industries. And they rigorously grade these companies using a moat rating system, assigning them either a wide moat, a narrow moat, or no moat at all. Their analysts are constantly debating and defending these moat ratings. The ultimate goal here? To find companies with the absolute widest moats, trading at the largest discounts to their fair value.
Moving right along to Section 4, Why Moats Matter Most. Let's bring this theory right back to your wallet, to everyday life. Think about how you make regular purchases. For most of us, it's just common sense to pay a little more for something that is highly durable. You might pay more upfront for a Honda rather than a Kia, or maybe buy a high-quality contractor's tool instead of a cheap lock-off from the corner hardware store. Why? Well, because that higher upfront cost is offset by years of reliable use. The exact same concept applies to the stock market. Durable stocks, meaning companies with economic moats, are intrinsically more valuable than companies that might go from hero to zero in a matter of months just because they lack a competitive advantage. To really see this contrast in action, just imagine two different companies. They're both growing at the same clip, both using the same amount of capital to generate the exact same amount of cash today. But one company has an economic moat. That protected machine is going to be able to reinvest its cash flows at a high rate of return for a decade or more. The other company? No moat at all. The moment competitors see their success, they will invade, and that vulnerable company's returns on capital are going to absolutely plummet. Which honestly leads us to the absolute fundamental takeaway of this entire explainer. The true value of a business is equal to all the cash it's going to generate in the future, period. If a structural shield, an economic moat, allows a company to generate high returns on cash for a much longer period before mean reversion sets in, that company is fundamentally, mathematically, worth more. When you can identify which companies actually have these moats, you ensure you're only paying up for the durable machines that are truly worth your money. So you now understand the basic game plan. You know about the relentless problem of capitalism, and you see why economic moats are the ultimate solution for durable compounding wealth. You get why they matter. But this leaves us with a million-dollar question, right? What are the specific traits that endow a company with these sustainable advantages? How do you spot a fake moat? And most importantly, how do you actually find a real one out there in the wild? Well, that is the ultimate question for your investing journey. Thanks so much for joining me on this explainer today, and keep learning.